Recording once again. Rocco, we're back. This is our third podcast now at this stage. We've gone from looking at personal branding to startups to meme stocks to loads of different shit. And today we're going to get in under the hood and get into some more details if you're up for it.
Yeah, Darren, how are you? So nice to be back. Feel like a friend of the show now.
Of course.
I mean, congrats being the number one career podcast in Ireland. That's happened since I was there. I don't know if I had anything to do with that. I'd like to think so.
You always did, of course.
Let's be modest about it. But yeah, so glad to be back.
Yeah, of course, man, of course. But I think what's sick is like what you're working on with your podcast is like, you know, down the finance route, down the fintech route, and then there's a lot of overlaps because like it's a careers podcast, but then touches off entrepreneurship, touches off like corporate careers, startup careers, and then there's always a nice like overlap, you know. So a big thing for young professionals like myself, I say young professionals because it sounds good, but really what it is just young people starting their shit, is that like we need to be able to use our money wisely. We need to be able to actually allocate it properly. So a big part that I've got into is investing over the last couple of years, rightly or wrongly, picking fucking stocks.
We'll get into that.
Yeah, but like doing some right things, doing some wrong things, you know. So a big part of a careers podcast is okay, let's earn income. Now let's use it wisely.
Yes.
So that's the idea. So basically, we've talked a lot about, you know, why should you start a portfolio, but we haven't really talked about like, you know, how to do it. And I mean now like how to really get fucking serious about it, you know, building something that's not like 1 or 2K, something that's long-term, and also having a bit of an understanding of like where the market goes. Like, so for instance, like I'm managing my own fund, and it's a pretty sizable condition. It's a pretty big enough portfolio. And last week or 2 weeks ago, with all like the talks about inflation and stuff, I lost 6% in the course of a week. 6%, man, on a...
That sounds like a crypto portfolio.
It does.
Is it a crypto?
It's a combination of both, but crypto is more violent, man. There's been days where I've lost 25% in crypto. Let's not get into that at the moment, you know, but just purely...
The 6% was the US equities, right? Yeah.
Yes, exactly. So like, you know, and for anyone that's like understanding this is that like, okay, if you're fully concentrated in US equities, you can get fucked from time to time. And that's exactly what happened in this scenario. So what I want to do is kind of get into that kind of detail, you know. And what's your initial thoughts on something like that? Like someone like me that's just shaving off all their earnings.
Yeah. So first of all, I mean, I think we have to ask ourselves why are we here, right? Because we have financial advisors, we have wealth managers, we have all these things in place, and you are none or neither of those. I am neither of those. Why are we in this situation? I believe the legacy system is broken because, and all due respect to those guys, they haven't kept up with the times, right? Because we have all this, the market is different. We have all these new things since 2008, and people have that just not kind of catered to the young, like this millennial, Gen Z, whatever crowd coming in. You know, this guy made like 100K with selling NFTs and now he wants to invest. He wears baggy pants and a flat cap. And on the other side of the table is this middle-aged, let's call him middle-aged white guy with big glasses, and he's sitting in front of his computer, and whatever this guy is saying to him, it goes over his head. There's a disconnect between the financial advisor and these young guys with new money coming into the market, really. And I mean, Darren, if you look at financial advisors, it's about trust, right? Mm-hmm. So it's saying that these guys like yourself, they're coming and saying, I don't really trust this system. I want ownership of my money. I want to sort of do my own thing. And I think that's not necessarily a bad thing. It's a good thing, like we talked last time. But now it's about, okay, cool. How do I do that in a responsible manner?
Yeah.
And I think that's where you start to think, okay, cool. What is the best case or the best practice setting up a long-term fund, right? Looking 5 years, 10 years, 15, 20 years down the line, depending on what your goal is.
Mm-hmm. Yeah, and it's interesting because you said there about like financial advisors. So myself and my close mate, Colm, we were looking a lot into this last year and about like what can actually a financial advisor get you. We actually looked into it. There was one in particular in Dublin. I won't obviously name it, but it was saying that they will try to get 4% on your return, okay, on your fund, but they'll also take a cut of like 1.5–2%. So then
I was about to say that they'll take 2 or 3%. You're not even covering like
exactly. So then let's say you make 1.5%, and then you pay capital gains tax of 30% on that. So you have 10K, you've made 4%, and now you're only actually taking like 0.8%.
Nothing. You could have just put it in a savings account.
Exactly. So that's why it becomes like more like, not active, but you take more control of it and ownership of it to do it. So like yourself, so that's an interesting dynamic. And the move towards fee, commission-free trading, obviously we touched on this before, is fucking huge. There's no like undoubting about that. But really for yourself now, what do you think some of those like pillars are that you mentioned?
Right. So there are five. Yeah. So there are 5 pillars of investing, and these pillars are not sequential. They're not linear. What I mean is like you don't start with 1 and then you move through to 1 to 5. It's like see them as together. Your house is standing on them, right? So the first pillar being how much help do I need, right? Because if you don't have, let's say, fuck all experience, then obviously doing your own thing isn't a great idea, right? So you have three options. You either go to a financial advisor, but at least make sure that you equip yourself with the knowledge to ask him the right questions and say, listen, this is what I want, or what can you give me, so that they don't bullshit you. Does it make sense, right? The second one is using something like a robo-advisor, which, I mean, GS has a brilliant one, Vanguard has a brilliant one. It's not an endorsement. I'm just saying robo-advisor is basically, I mean, you know about robo-advisors as well.
Mm-hmm. I do indeed.
Yeah. And then the last one is like completely doing it yourself from scratch, which we will cover like a bit later on. And then we move, so obviously you have the experience to do that, right? So, and then the second one being, what is the platform, right? What is my platform? Because in America, you'll use like an IRA. In UK, you'll use like, let's say a brokerage or whatever you want to use. But you need to decide what is the platform that you actually want to build your long-term investment on. Mm-hmm. Third one is asset allocation. Right. Sorry, before we get to asset allocation, is risk profile. So you get predominantly 3 types of risk profiles: low risk, moderate risk, and aggressive. Depending on your age, you're like what, 25 now? Mm-hmm. Yeah, okay, so 25, you'll maybe like want to retire at 50. Let's go 50. Let's not go 60. You'll want to retire. Let's go. Look at, then you'll go super aggressive, right? You'll go super aggressive. You'll have 70% of your portfolio in equities and the rest diversified. Moderate, you'll look at something like 50% or less, and then conservatively you'll go something like 10 or 20% equities with the rest in bonds and ETFs and stuff. But okay, so next pillar, asset allocation, right? How do I actually take this money and allocate it? Right here, you look at equities. That's where you go and stock pick, which is like Warren Buffett. It's not easy. Once again, and you see how the first pillar comes in now and saying, okay, but how much help do I need? Can I do it myself? Do I need a robo-advisor if I've got like intermediate skills, or do I go to a financial planner, right? Mm-hmm. Okay. Then at equities, commodities, bonds, cash, crypto. Those crypto only being recent, those are your main allocations. And then the last part is just checking and rebalancing. Every quarter, you can choose, you don't have to, but every quarter or every year, you just check your portfolio, rotate out of some positions, and rebalance, which we'll cover, I think, later. So, I mean, I hope that makes sense.
Yeah, it makes sense. It's just difficult also to manage all those different areas, especially like if you're going from like 5K to 10K, for instance. Yeah. It's like, okay, you've had your first 5,000 that's in equities. And that seems fair for most people. They're buying a bit of Apple, they're buying a bit of Netflix, a bit of fucking Tesla, whatever. But as they're getting bigger, should you be moving your money into more of that? Or should you now say, okay, the next 5K should go into your bit of diversified, maybe move into ETFs at that stage? You might start thinking a little bit broader. And like, I'm saying this even from my own perspective.
Yes.
Like, let's say, as I was saying there earlier, so like looking at my own portfolio literally live as we're doing this, and
39%. If it's crypto, it shouldn't look that bad right now. But I mean, yes. Let's give it 5 minutes.
But I'm saying, like, overall, like, I'm about 39% in equities, 33% in crypto, and then I'm holding 28% in cash at the moment. So that's a lot. It seems pretty high, you know. So that's why to get to like a next level, is it a time to say, okay, well, this is too overly exposed. What are my options in this period? Should I go be looking for other areas?
Yeah, so I'm a big fan of diversification, but not over diversification. If you over diversify, then basically you're just watering down your returns. So pick like 5 to 10 main stocks and pad it out with anything you like. But I would look at things like ETFs, right? ETFs are fairly safe. MSCI World, US trackers, these index trackers have been proven time and time again to be relatively low risk or medium risk, high return investments. The other thing that you can look at is bonds, like 10-year bonds, maybe. The returns are like 10%. It's not high, but it gives you over those 10 years a sustained, you know what you're going to get, right? There's no big major shocks or surprises. The thing is just 33% crypto is really high. I mean, I'm an advocate of having crypto in a portfolio, but not more than 5%, just because of the sheer volatility over like a 5-year. We don't know what's going to happen. It's a best guess because there's no historical information, right? Because I mean, even if you're picking stocks, you're picking it based on what
reputation.
And well, there's PE ratio, there is the balance sheet of the company. What are they doing? Is it growth? Is it value? What exactly? Yeah, I can mix a bit of technical analysis, not really in long term, but there's nothing really on crypto to say this is what it's going to do over 5 years, 10 years. So that's why I say that 33% is a bit high for me.
It is a bit high, I suppose, and I completely agree with you. But I suppose the counter argument to that as well is that like they'll go through like various bull and bear markets. They have certain periods where they're getting pumped to fuck. Now, I do wish to unwind this position. There's no two ways about that, and I'm not like giving like advice for it. But I'm saying like the crypto kind of like bro would say that okay, over the course of the last 13 years, we've had plus 20 crashes, and then it's always rebounded. So if you are looking at it from the perspective of 5 to 10 years, and that's a bullish perspective on it, of course. Yes. But I think like that's the historical data. That's okay. And you also don't base future returns off historical data. But I'm trying to say this is where the parallel comes in.
So what I can say to you is that if you want to go and you want to go safe as you can go, Ethereum would most probably be your safest bet, just because of the smart contracts that are built on Ethereum, the tokenization that's happening, NFTs are not going to go away. They're just going to we are at the infancy stage. But well, the thing is that people don't understand about NFTs is like you like to own things in the real world, right? So whatever you will own in the real world, you will also want to own in the digital world. Why? Because we like to buy things that we don't need to impress people that we don't know. And you want to do that in the digital world. It's, I can take a picture or I can copy a JPEG, whatever, but you don't own it. And the people in the digital world know that you don't own it. It's pure vanity, but that's what it is. And that's where Ethereum is sort of placing itself. Secondly, Bitcoin. I'm not convinced about Bitcoin as a currency. Yes, there is adoption in countries like El Salvador and now looking at Brazil, maybe, but I'm not 100% positive. But those two are your safest bets. Even if you look at the year-to-date return, it's hard to beat anything at the moment. Like when you look at those two, I would pretty much try and stay away from altcoins. Altcoins are for the people that it's just alternative coins, right? These are we touched on that last time. If you want to incorporate crypto into your portfolio, look at Ethereum first and then possibly look at Bitcoin second.
Yeah, I completely agree. Like my other close mate, Tom, like he's a always been a long-term crypto guy. I thought I spoke to you about him previously as well. And he has his head like fucking screwed on with this stuff. And his thesis is like all these shitty altcoins are going to zero long term for the most part. Obviously, you'll find a couple of different variations, but for the most part, they're driving to zero, you know?
Right. So here's the thing. There are massive fractals. A fractal is just a combination of indicators. It can be 3 or 4 indicators that are suggesting that there's a high probability that your major cryptocurrencies are going to go parabolic, right? This is purely technical analysis, purely in the short term, which we're seeing the same fractals on the opposite side of gold pushing gold down. So it sort of makes sense. So to me, it doesn't make sense getting rid of all your crypto now. Maybe rebalancing a little bit because of it's outperformed that much, but I would not necessarily get rid of everything. It's like it would be the equivalent of selling high or buying high, and selling low or something. Yeah, the opposite. You know what I mean?
And what's interesting there is like you had a post I think previously, or was it a post? I'm not too sure, about the dudes that bought Bitcoin at 60K and then they like held in pain and agony the whole way down to when it got to like 30K.
Yeah, because you don't. Yeah, but the same for any asset. Sorry, the same for any asset allocation. You do not buy at all-time high. I'm sorry. Gold, same. 2,100 was it? Look where it's now. It's been stuck there for fuck knows how long. Bitcoin the same. And this, I always say in my posts on LinkedIn, I said, people who have a lot of this stuff, they want to accumulate more at the lower price point. Obviously, they are going to artificially buy the price down so that they can buy more at a cheaper price. And I mean, Bitcoin was the best example of this happening. When it went from that all-time high to 30, yeah, it's dead. It's going to go, like people say, 11, 9. No, maybe one day, not now. It's too much cash in it. These people have too much interest in it. I mean, the USA came out yesterday and said, we're not going to ban crypto. So, I mean, there's rumors today, crypto ETF coming. If the Bitcoin ETF happens, there is going to be a massive price shock. First of all, Bitcoin might go down, and then it's going to go up because of the liquidity, just the sheer amounts of people. Because remember, ETF is a very nice instrument. It's an easy instrument. I don't have to know anything about it to just dollar cost average into an ETF. A lot of people are already doing it with other instruments. So why would they not do it with Bitcoin? So there's going to be a massive surge.
Yeah, it makes a lot of sense. And I completely get behind you as well. Like I'm not saying that we're going to use Bitcoin in a fucking shop tomorrow. But I'm saying... Go ahead.
No, I'm not a crypto bull. No, I'm not a crypto bull. I'm not a Bitcoin bull. I'm a realist, and I look at trends and I see trends. And my trend for this year was gold is flat. It's going nowhere between 2,000 and I think it was between 2,000 and 1,600. That's why I didn't put gold anywhere in anything, because I knew it was going to be flat because the chart says flat. It's flat. Crypto, different story.
Yeah, no, I completely agree. And I think the last point on that is about, even though you don't think it's going to be used in a fucking corner store, that does not mean the price can't go absolutely intergalactic, and you're saying that
it's what ETF, it's
or going to Brazil or whatever, what I mean? We can't say that it can't happen. So that's why I prefer to be just completely unemotional to all this shit. And if you have a bit of exposure, maybe 33% isn't the best approach. But you know what I'm trying to say is that like overall, it's it's just something to be considered about.
So if you sort of follow this narrative, right, that whatever you don't buy into the narrative, because anything has value because we assign value to it. Someone decides something has value, right? If everyone in the world tomorrow wakes up and say, okay, the Bitcoin doesn't have value, it won't have value. If more people say it has value, it will have value. You get what I'm saying? So you're essentially taking a risk in saying, well, probability of more people saying that it has value, which it looks like it's going to be the case, right?
100%, and it could be dumb money or whatever, but that's the idea.
But
A lot of
just
those people did accumulate
if you
beforehand.
cap it, yeah, but if you cap it at 5% in a long term, 5% is nothing. It's not enough to capitulate your whole portfolio, but it's enough if it goes 1,000% to be a nice nudge.
Exactly. One thing you touched on there, which was really interesting, you were saying about like not picking fucking highs and selling lows. So
Yeah.
S&P is like, you know, at its all-time high at the moment, pretty much. And I suppose
Yes.
what's near, or even is it at that point? One or the other. But basically, because it's so close to the top, you know, is there a considerable amount of information to say maybe it's time to take a step off equities? Maybe it's time to rebalance off this. Is this an indicator that people should look at versus kind of blindly investing in, even if it is dollar cost averaging, because you could potentially get burnt if there is a sufficient pullback?
So if you built your portfolio at the start of the year or whenever before this happened, you wouldn't care, because a long-term portfolio, it's like a 5-10 year, you don't really care about it. You'll probably, after a 6 or 7% dip, you'll buy more just because it's gone on sale. If you want to start now, there's enough people out there besides myself saying, listen, you might want to take some cash off the table. It might not be the best time to go in because we're going into an earnings season, and it's meeting a tapering Fed that's in the mood to taper the bond purchases and asset purchases. So you don't really want to go in. I'll wait for Q1. If you want to start like your own fund, whatever, I wait for Q1 of next year to see where we are post December, and maybe start like Jan.
Things get vicious, you know, and if they do have a rapid pullback, and if you are starting a fund, that's when you're going to start fucking selling into it, because you're going to see a minus
exactly
6% or 10%, and then you're just going to be gone. Then, you know.
Yeah, because remember, you are not trading. You're not shorting the market. If you had a fund now established, you could take a derivative position where you short against like certain positions that you hold. That would have been, like, we call it hedging, hedge accordingly. But now to start a fund, that's maybe not the smartest thing to do.
Yeah, you touched on an interesting point there. So Simon Ree's post recently the other day was saying about, you know, if you're thinking of hedging now when the market turns, that's when it's too fucking late. But one thing I wanted to ask,
it already turned a bit, so it turns out to be correct because you were too late.
Exactly. But in general, like, as your portfolio gets bigger, so you go from 10K to 20K or 20K to 30K, what sort of hedging should you be looking for? And even like myself, like a lot of time, like, could be just fucking going in blind with a lot of this stuff. So where is it you actually look? Because obviously, you know, people say like Bitcoin's like the hedge or commodities is the hedge, but is really looking
just
at
a narrative.
Exactly.
No,
but
gold,
is looking at something like gold, silver.
No, gold. I'm not buying. I've never bought into the gold as a hedge narrative, because if you look at it, it's the facts aren't there to justify that it is. Mm-hmm. The same with Bitcoin. If your profits have been good, just reinvest some of it into what works. Look at your sectors. I mean, when you're picking stocks, right, you need to pick into sectors, right? So if it's like financials, industrials, pharmaceuticals, whatever, if one of those industries are performing very well, just reinvest it, because you remember, you are already diversified. You don't need to diversify yourself more. You just need to take some of those profits and reinvest it.
Yeah, that's interesting.
But don't buy into that gold is a hedge, because there's no truth in it. I mean, it's a narrative, mm-hmm. and people like to believe it's true, and
it's because it sounds professional. That's the reason why people think, oh, it seems a good idea.
I do believe gold is generational. If you look at, but I mean, you're talking maybe my children's children, right? Then we'll see like $3,000, $4,000, $5,000. But to say short term, it's a hedge against inflation. We're in a pretty shitty inflationary environment now, and it's still it hasn't gone. So you can say, yeah, it's artificially manipulated, whatever. I don't care. Mm-hmm. The facts are that historically it's shown not to be. So, yeah.
Yeah. You can only just play with information you have at the moment versus like thinking.
Correct. Don't buy into a Marxist narrative about, it's Bitcoin is the be all and end all. Gold is a be all and end all. Silver is a be all and end all. It's never one thing, right? That's why you call it a diversified portfolio.
Makes a lot of sense. So I think the biggest difference between my generation and yours is the fact that you've been through several like bear markets, not several, maybe like one or two bear markets, whereas we haven't really, No. So I think like what's been like the biggest learnings you've seen since like 2008 or even prior, like that have really
panic selling, because when there's red and it looks fucking horrendous, it takes big balls to stay in the market, right? Well, I'm talking about the Corona correction, and to when you sort of fundamentally say and technically say that we've reached a bottom, this market is bottomed, to buy more, because you make money where in the movement where the price is going, right? Not like when it went there and now you're trying to, you know what I mean?
Chase the market.
So yeah. So basically to buy on red and to sell on green, because mentally in your mindset that your brain goes, not doing it. You can't. And I think that's where that 2008 wasn't that involved, but in the market at that stage. But I learned through that, because if you go back into history, you can learn from it. And this Corona correction was exactly the same. People saying, the stock market's going to crash, it's going to go up in flames, it's going to lose everything. You know what? Still might somewhere in the future, but sure as hell doesn't look like it, right?
100%. And if you think about it as well, that recovery in general, so Corona crash was like the shortest crash of all time. Obviously the blip happened, and then to get back to its natural levels took 6 or 9 months or some shit, which is quite interesting. But when Max Passion was on my podcast a couple of weeks ago, we were talking about the lost decade, if you're familiar with that concept. So for anyone that doesn't know, basically it was the only decade in history whereby if you invested at the start of the decade and if you sold at the end, that you'd lose money. So it was the only decade in the history of markets, which was 2000 to 2009. And there was still one fund that actually became profitable, but there was no one fucking left in it. The people who invested in 2000 had felt so much pain and agony from 2006 to 2009. They were all out by 2010. So that's why, it's interesting, because when you're at like my age, like it's almost like not cool to say like, oh yeah, you're like investing long term. But to be honest, when you look at those statistics, it just seems like that no matter where you flinch, is that it's going to work out, beneficial if you just have some sort of like unemotion to it. I think that's the biggest learning that I've had, is that like, shit hits the fan. Do not make any irrational decisions. And
just WhatsApp me.
Exactly. But it's interesting, like if you just compare it to the last decade and think, okay, there's been one decade in all this period. But to be fair, Max made a really good point. He said, okay, that's fine, but what about if you've been feeling these losses for so long and then you just absolutely lose your mind and you pull out? He's like, there's the other side of it, of the day-to-day.
But when I say phone me, it's not phone a financial advisor or phone someone. It's phone a buddy, like phone your, so just someone to sort of a sounding board and say, because we make irrational decisions when we are stressed, and I mean finance puts a lot of stress on you, but I mean that's the thing about investing in the long term, is you shouldn't really care. You shouldn't care, because the probability that you're going to be up in 10 or 15 years is greater historically than being down. Now, sure, we could go from, because we had the sharp pullback of the Corona correction, and that's where we had this elasticity which bounced us up from the Fed printing money, whatever, stock buybacks, whatever. So we might go through a period in the next couple of years where we will see sideways movement and we'll see very shitty returns, because we've got so used to, I mean, you could have thrown money at anything this year and could have made a lot, like triple digits on stocks. So we're going to go through a period where it's not going to look as sexy. The numbers aren't going to be as sexy, and people are going to be deterred or whatever. But they forget it's a long game. This is like a 5 to 10-year game, and it's have you met my eighth wonder of the world friend, compound interest and reinvesting? And that's the beauty of a diverse portfolio. Even if you take hits, then if it's fundamentally built correctly, you should still be fine.
Yeah, and that's why I think using something like an ETF is the best approach, because if it is an equity, you could just get fucked, and the company itself could be shit.
Absolutely.
So like, if you look at companies like Plug, for instance, that was in renewable energy. It's one of like a big like US like renewable energy tech stock. It had like a 1000% run up during COVID, and then obviously it didn't deliver on all of its expectations and ripped back like literally like 90%. So someone
pulled the plug.
Yeah, someone pulled the plug, exactly. So that's why it's kind of interesting, because like if you pick the market, take the market.
That's such a dad joke.
But it's true though, and that's what you got to kind of equip yourself with.
Yeah, but I mean, there's brilliant platforms as well. We haven't touched on platforms really. If you want to do this stuff, there's if you're in the States, there's Vanguard. Vanguard has brilliant platforms, and I talked about the robo advisors. There is a platform in the UK. It's a newish one called Wealthyhood. It's something like a top 20 startup app, whatever, but and you can find everything on there, and it's just super easy to use. Like, it's not endorsed, not a sponsor, not getting paid to say it. I'm just saying it's something that I've came across. They are very transparent. The fees are reasonable. So if you want to go and look at it, it's something you can go and look on, because you need to build it on something, right? If you want to go really professional, like I'm talking about like a sort of a hedge fund. Yeah, like it's called Mars. It's called multi-asset risk systems. So you go and get yourself a Mars system. Just go Google Mars systems, and you'll get one. It shows you your whole portfolio, your risk allocation, everything. But I mean, then you're sort of running your own hedge fund. You know what I mean? So
yeah, exactly. I mean, that's not
and
necessarily.
None of us are going. I mean, you're not going to go and run your own hedge fund, because then you're trading with other people's, or you're investing with other people's money and not your own. So
of course, you got to be a little bit more wiser than this dumbass over here. Any other further thoughts that you think is relevant towards the retail investor to make sure you're not fucking up?
Yeah, I think the retail investor needs to be encouraged, right? And it needs to be taken away from trading, because it's not trading. It's taking ownership of your own money, and find yourself someone that you can do it with, right? Someone, because like sort of a backer buddy system is also cool, because like if you tackle big projects, whatever, it's always better to do it with someone than go in completely alone. It's just like sort of someone that maybe a bit more experienced than you, that can like sort of guide you and give you a couple of pointers and tips, just so that you're not, if you do fuck up completely, whatever, or make sure that you don't do it.
Of course. Yeah. And I think especially what we're doing now with podcasting and everything, like doing it with someone is just 10 times better than doing it on your own. And it's that kind of sanity check, as you said, because otherwise like you'll get very much lost on your own and just give up. And that's the last thing you want to do, is just to call it quits.
Because it's not it's really not rocket science, but it can get very alone. Mm-hmm. And it's not looking for validation. It's just looking for, I would guess, community, or like just saying, oh, fuck, did you see this? What happened? Whatever. And then, okay, cool. Let's fucking go on from here.
Of course. Okay, Rocco, I'm going to stop it here. And I say a massive thank you for people that haven't checked out Rocco's podcast, SGM Podcast, on Spotify, on Apple. We're also going to get you on YouTube. We're going to fucking sort that out. Get these. This video is going to be our first YouTube video.
Guaranteed. And I'll get you on Twitter.
but YouTube is fucking easy. Like, well, it's not easy to do well,
And
but it's easy to
Twitter is
upload.
fucking easy as well.
But I can't be writing more stuff, man. Like, as in I'm writing on 3 platforms every day, and I'm literally losing my mind. So the easiest thing is take these fucking video files. I'll send you a finished version of it, and you can upload it straight to YouTube.
Sounds good.
Awesome. Thanks, man.
Cheers.